Hello everyone. Let us start with a look back at 2025. The year 2025 was clearly a tale of two halves for India's rates and currency markets. The first half of the year unfolded broadly in line with our expectations and in some respects even better. The rupee remained largely stable. Forex reserves were rebuilt to a peak of $703 billion by end June, and the RBI delivered an aggressive 100 basis points of rate cuts. Government bond yields responded favorably, with the 10-year bond rallying by about 50 basis points. However, the tone changed meaningfully in the second half of 2025. A negative tariff surprise for India, initially seen as transitory, began to have a more persistent impact. The rupee weakened sharply by about 4.2% from July onwards, making it one of the weakest performers among emerging market peers. Forex reserves declined, with the RBI increasingly shifting pressure from spot onto the forward book. Despite another 25 basis points rate cut in December, government bond yields moved higher by 25 to 30 basis points, highlighting the growing dominance of external factors over domestic fundamentals. This divergence is striking because India's domestic macro remained very strong. The RBI now estimates fiscal year 2026 GDP growth at 7.3%, up from 6.7% at the start of 2025, while average CPI inflation has moderated sharply to around 2%. Yet markets remain focused on the external front, particularly the uncertainty around a potential trade deal with the US. As we enter 2026, India faces a delicate balancing act across growth, inflation, liquidity, and currency management. Let us address a few important questions. Can India sustain growth without reigniting inflation? In our view, yes. Even with trend growth of 6.5% to 7%, inflation is likely to average around 3.5% in 2026, comfortably below the MPC's 4% target. Structural factors, along with a normal monsoon and stable global commodity prices, should keep inflation well contained. Is there room on fiscal and monetary policy levers? On the fiscal side, space is clearly more limited after the expansionary stance of 2025. As the government transitions towards a debt to GDP anchor of 50% plus minus 1% by FY31, fiscal policy will require careful calibration. State finances remain relatively weaker and will need close monitoring. On the monetary side, most of the heavy lifting is done. That said, we still assign a greater than 50% probability of one final 25 basis points rate cut either in February or April 2026. Beyond that, we expect the policy rate to settle at 5% for a prolonged period with no rate hikes in 2026. Will bond supply pressure yields higher? The centre is expected to balance its objectives without materially increasing GSEC supply. However, state-level borrowing is likely to remain elevated, with a substantial pipeline of HDLs in 2026. We expect RBI open market operation purchases of 1.5 to 2.5 lakh crore in Q1 of 2026, with an additional 2 to 3 lakh crore over the rest of the year, depending on FX reserve dynamics. This should support central government bonds. A key upside risk would be confirmation of India's inclusion into the Bloomberg Global Aggregate Index, potentially leading to 15 to 20 billion US dollars of FPI inflows, creating a very supportive technical backdrop for government securities. However, we remain cautious on SDLs, where supply pressures are likely to persist, keeping spreads elevated from already high levels. Credit growth is likely to accelerate from the current 11% range, while deposit growth remains constrained around the 10% level. With reserve money growth still subdued, the RBI will need to remain proactive in injecting liquidity to ensure effective monetary transmission and avoiding the tightening bias that emerged in the latter half of 2024. What will arrest the rupee's weakness? The rupee remains the elephant in the room. A favorable trade deal with the US remains the most important near-term catalyst. Historically, sharp bouts of rupee depreciation occur every few years, followed by periods of stabilization driven by domestic fundamentals. On a real effective exchange rate basis, the rupee has already weakened nearly 10%, making valuations very attractive. While timing is uncertain, we believe we are closer to the end of this depreciation phase with the potential for stabilization or even a reversal if supported by trade progress, policy-driven inflows and index inclusion. Against this backdrop, we are taking a neutral stance on duration, favoring accrual strategies with flexibility to take tactical duration exposure as opportunities arise. Near term, we favor the 2 to 3 year corporate bonds where spreads have widened to 90-95 basis points over government securities and offer attractive carry. As liquidity improves into April 2026, we expect opportunities for spread compression in this segment. We remain constructive on the 7 to 12 year government security segment, which should benefit from OMO support. The 30 to 40 year segment remains a tactical opportunity. We also stay underweight state development loans in duration products due to supply concerns. 2025 kept markets on their toes, with tariff shocks, a low inflation, high growth paradox, policy uncertainty, and a volatile rupee. While 2026 will bring its own set of surprises, India's resilient macro fundamentals provide a strong foundation. A nimble, selective approach will be key as we navigate the year ahead. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.